Welcome everyone. My name is Chris Thomas and I am the Executive for Commercial Broker and Equipment Finance Sales at NAB. It is my pleasure to introduce this NAB Economic Live webinar. I'd like to start by offering my best wishes to those joining us today from the many parts of our country impacted by severe weather. Australia is a lucky country, no doubt. However, you've got to be tough to live here for sure. Before we commence though, I'd like to just go through some housekeeping. Kat, can we please just have up the housekeeping slide, thanks? Thank you. Today's session will be 45 minutes, inclusive of a 20-minute Q&A. I therefore invite you to use the Q&A function located within the Zoom feature to write your questions as they pop into your mind. We want to see plenty of questions and we're really excited to be able to take those towards the end of this session. Thanks, Kat. Now let's get into it. So firstly, I'd like to thank all of you who have joined today for your ongoing partnership with NAB. Together, the role we play in advancing our economy by supporting the millions of business owners build prosperity in our economy is of the highest importance. NAB is committed to backing you and your customers by providing the best experts, products and services that unlock the creative spirit of SME Australia and make more of their ideas and build prosperity together. Today, of course, I'm proud to introduce our keynote speaker, the always insightful Alan Oster. Alan is our Group Chief Economist and for many years the Oracle of NAB. He is one of Australia's most respected voices in financial services, and I'm sure all viewing today will take great value in what he has to say. Without further ado, welcome Alan.
Thanks, Chris. It's a pleasure to come back again. I've got about 20 minutes where what I'll try and do is give you a quick overview. If anyone wants a copy of our slides, just get in contact with us. Chris probably as good as any, and we'll send them out. But what I'm trying to do is give you an overview, if you like, of what we're seeing now. And a lot of it is pretty encouraging, to be brutally honest. So I'm going to start by basically talking a little bit about the globe and then spending a lot of time on Australia. On the globe, basically what we've got is economies that were hit hard last year coming back pretty well. In Europe and the UK, you're now in a phase where they've locked down again. It looks like it's going backwards. That was happening in the US, although then Biden has basically come out with some massive fiscal packages. The one that just got through in early January was basically 9% of GDP. The one that got through in December was around 3% of GDP. And to give you a context, those two packages together represent 3% of global GDP. So that's all going into the US economy. That's made us change our growth forecast in the US from 5% to 6%, and some people are saying 6 to 6.5%. The Fed is still saying things are in trouble, and so we need, and it'll be bumpy. So they're keeping their quantitative easing going flat out. China has recovered a lot quicker because it's went into its headline problems last year in the first quarter rather than the second quarter. Europe, as I said, has been hurt a little bit. What we're sort of all assuming is that we won't get another big lockdown because of viruses globally. So we've basically got about a 6% increase in global GDP after about a 3.4% fall last year and then getting back towards trend growth in 2022. I'm going to talk a little bit now about Australia. Obviously, we got a massive hit last year in the June quarter, 8% down, but the recovery has been spectacular. It's been something better than anybody would have thought, even particularly 12 months ago or even 6 months ago. Well, what we're seeing now is really very different. National accounts had assumed or shown you that there was a 3% increase in the December quarter. There are some assumptions we're making. Number one, that we don't get another big outbreak of the virus locally, and half the population gets the vaccine by the middle of the year and the rest by the end of the year. And going forward, we think the Reserve Bank will certainly keep monetary policy as stimulatory as it can. And the government, I think it's important that they try to keep helping sectors that are still struggling. In terms of going forward, we think during the course of this year, in other words, December on December, about 4% growth, but given the really strong end of last year, just the arithmetic means that you get something like 4.6% growth this year, and basically something like 2.5% next year and maybe 2.25% the year after. It means you're going to get some really big falls in unemployment. For us, unemployment's probably down around about 4.7 by the end of next year, and maybe 4.4 by the year up 2023. I think what the government's trying to do now is move out of a phase of just keeping everything alive to basically moving on to try and stimulate the economy and help the recovery as you go forward. So, as I said before, I don't want them to take out too much stimulus too quickly. I think they need to diversify trade, and you're seeing that with the Quad. You need to improve some of manufacturing, and see particularly health manufacturing plus a few other areas that essentially will help our supply chains. And then they're looking to see what they could do that's beyond that as you go forward. So big picture is really encouraging. This is just a few quick slides. This is essentially GDP, the whole, and where are we now? And basically what it's saying is, as of now, we're back to about the level that we were before this all hit. In terms of employment, we're already there. And again, we expect to see this sort of growth as we go forward. The green line here is just the government's contribution to essentially household budgets. And what you saw through time was a big reduction through time. And then you got this massive spike in household income. That's called JobKeeper. And it's all the other packages you had. And that has then led up to this big increase in spending during the back end of last year. Before you get too optimistic, if the virus hadn't happened and we'd just grown at potential, we're not really back to potential to about 2022. And so there's still potential rocks in the road, ups and downs, and the government's going to be very careful about what it's going to do in terms of removal of stimulus. A lot of people ask me about the currency. These are what our models are saying. So the red lines are 95% confidence. The models sort of want about 83 by the end of the year and then about 80 thereafter. But do remember, this is weakness in the US dollar, not the Australian dollar. So if you're importing something from Europe, the euro hasn't really changed, around 63, 64. Then I'm going to spend a bit of time talking to you about some of the data we see internally. And what we do these days, and this is very different to what we always have done in the past, is every Wednesday, I basically report to our CEO and a couple of other senior people what's gone across all our electronic systems for the weekend, the previous weekend. So we're about 4 days old, is basically where we're at. We do that for transactions, and we also do it for essentially revenue coming across the corporates and also small businesses in Australia. So red is basically retail sales, and it's still travelling along, around 6 or 7%. Now, the problem with some of these charts are that it's now going to be starting to be affected by what happened this time last year. Because what we're doing here is we're comparing the same week, in other words, last week, compared to the same week last year. And what you saw last year was a bit of a spike in supermarket spending, particularly buying toilet paper and all that sort of stuff. And so where are we now? Already, we're starting to see supermarkets down 20% on what they were in the same week this time last year. So the other way we sort of starting to look at this is the dotted lines are the same path last year, but I've indexed these lines until the beginning of the year. And what we're sort of seeing is in the last week to the 13th of March, retail's a bit softer than what it was at the beginning of the year. Hospitality is a bit stronger. So going forward, what we're going to be trying to do is to look at relative to where you were at the beginning of the year. Now, it doesn't pick up seasonality, and there are seasonal patterns, but it might give us a good feel. But generally what we're seeing, I suppose, in this data is a pretty good outcome. It's saying, okay, after 6% plus in the back end of last year, the economy is still not losing anything relative to that. And in hospitality, which is the black line, it's actually a bit above. There are, however, some problem areas. One of them is accommodation and food. The other one's people like travel agents, particularly international. And the other one that's important is CBD. Now, basically accommodation on the top left-hand side, black is Melbourne, it's the index, and I've indexed it to the end essentially of 2019. So Melbourne is down 60% in the CBD accommodation, but nobody else is better than 40% down. If I look across at the top right, cafes and restaurants are also pretty poor. Melbourne's the worst, but most of them, other than Adelaide, are still significantly below where they started. The only exception to that is down the bottom, where clothing sold in the CBD, but a lot of that's going to be online, is back to normal. And in clubs and pubs, and even in Western Australia, things are doing really well. You can see as of now, they're all down 20%. So CBD and therefore commercial property is going to be an issue as we go forward. So if I go down, this is the same thing, just looking at by various states. Western Australia is the strongest, but all of them are starting to come down now based on that 12 months comparison. I'm going to move on to looking at corporate, or essentially business. So we're 30% of the business in Australia. And it's basically looking at the flow of income coming in, or revenue, over a 6-week period versus the same 6-week period last year. And what you get here is it's starting to slow for the same sort of reasons in supermarkets, etc. But what's really important, and people miss all the time, is we can break up the revenue with and the revenue without JobKeeper. And over on the right-hand side, you see there's not a lot of difference. And in most places, there's not a lot of difference. There are some areas that are sort of in trouble, and particularly accommodation and food. And also, as I said, CBD, travel agents. Small miners, for some reason, are not doing that well either. And it could well be that part of this is associated with commodity prices. The next chart I'm going to put up is not going to, I don't even look at it in the sense that there's a lot of data. But what I'm trying to show you is, on that data, we can look at it essentially for SMEs, by industry, by state. And the big sort of takeouts are Western Australia is the strongest. Victoria, while it's growing, is lowest. Areas that are strongest are services, finances, health. Wholesale, not surprisingly, is slowing, and then you get arts, recs going backwards. So all our data is, that's the sort of, as of a week ago, data internal. Then we look at our business survey, and I've been running the business survey since I introduced it in '96 on a monthly basis. This is capacity. The blue line is the raw, the red is the deviation from trend. And so what you've got here is we lost 10% of capacity when the virus hit. We're now above where it was when it started. And when we look at some of the other things in our business, our February business survey, and we're about 2 or 3 weeks away from our March one, was probably the strongest survey I've ever seen internally. So here's forward orders. Again, you can see the massive hit, you can see the trend, and you can see where we are now. And in forward orders, you actually have to go back a long time. I think it's 2010 since you got as strong a read in forward orders. And the other thing I'd say to you in general, everything in the survey is like that. So the three things you may have heard a lot about: business conditions are their outcomes, their forward orders, and their confidence levels are above long-run average forward. In terms of which sectors are doing best, retail and big miners, basically. But everybody's coming up, even construction, which has been the weakest, has come back to normal, essentially. And again, if you're looking at it by state, you're seeing, again, Western Australia is the best. New South Wales is now about third, and you can see Victoria coming back quickly. So I think it's a pretty good outcome. You're looking at inflation now. Pretty soon you're going to have a headline inflation number that's above 3, and that's because some things drop out on a 12-month basis. The blue line is the line you should be looking at. That's core inflation. And basically what's happening is they take out the top 10% of price rises, they take out the bottom 10% of price falls, and they average the rest. And they're aiming to get inflation in this 2 to 3 range. And our central bank has said until it's in the middle of the 2 to 3 range, we're not increasing. To get that, you need wages above 3.5, something like that, because we get productivity. So we don't have the Reserve Bank, even out to 2024, above the end of 23 here. We only have it at the bottom of the range, which is why I think it's going to be a long time before you see RBA increasing rates. A few comments on house prices, because I know everyone wants to know about house prices, particularly brokers. That's a bit of history. And what you've seen is you've seen the dip, and then you come back, Melbourne, Sydney, and it's sort of, we've taken this back to 2000 in terms of our level. But obviously, and I'm sure you guys have heard about it, when you look at the 6 months annualized, and everything's turning up. And, you know, we think most of the rest is around 10% up already over the last 6 months at the annualized rate, which surprised a lot. This time last year, we were really worried. And when you think of the big drivers, population growth. So the population growth, there's no immigrants coming. We're assuming that they're not coming, we're not opening the international borders until next year. It's the lowest growth rate for 100 years. That's normally hurts. Unemployment got to around 7.25. It's now 5.8, which is really good, but normally that would cause you grief. And rents, there's still a lot of rental problems in CBDs. I think one of the big issues we're seeing is change of work. So if everyone's on Zoom, you don't have to come into the CBD as much. And so you'll buy your coffee and you'll buy your house in a local area that is where you live, where you're happy to live. So as long as you've got internet, you know, if you're in Melbourne, you're happy to work from Bendigo, Ballarat, Geelong, Sydney and the Western Blue Mountains, Queensland, basically Gold Coast, Noosa, that sort of thing. So you will see big differences in house prices according to region. And the regions are going much faster than CBDs. The other thing we're seeing is interest rates, which are low, and as I've just said to you, they're going to be low for a really long time, particularly the variable rates. And what we're now starting to see is a situation where you can buy a property and put it on a mortgage, and the mortgage cost to pay it off will be less than if you just rented that home or that house. So big demand, a lot of applications coming in, and we see them. The trouble is, just at present, there's also a lot of going out the back door. In other words, people are reacting as if these rate cuts didn't happen. So the increase in growth in credit is actually quite moderate. So it's around 3.5%. But obviously the Reserve Bank and APRA will be looking at this data, and if house prices keep going at the rates they're currently going, then they'll probably be looking to lower the valuation ratio effects. Basically, this is our expectations. It's called dwelling prices. I think house prices are roughly 10% everywhere, maybe 5% next year. I think apartments much more modest. And that's how you get the 8 and 6 rather than the 10 and 5 in terms of that. Okay, a few comments about where the economy's been and where we're expecting to go. This is important in context. The blue lines are basically domestic demand. And that graph goes back to the 80s, and you can see there's never been the domestic demand falls like we've got. And what filled it in was obviously the public sector. And as we go forward, we're going to see a lot of slowing, obviously, but still pretty significant growth. And that's why you need fiscal policy. We're all hoping that business investment picks up, but other than expectational data, we're not actually seeing it happen yet. We're seeing a 30% increase in applying for loans, but paying off even quicker than the housing book. So I don't think business credit is going to grow at all this year. Let's just give you a focus about the recovery. The black line is through the year growth, and the red line is the quarterly. So we have something a little bit 1.25-ish, and then sort of more return to normal, but ups and downs a bit. But normally that would be pretty strong. Through the year growth above 2 for quite a while is not usual. Let's put it that way. Unemployment was surprised everybody about how quickly it's dropping. These are some internal numbers that we're looking at as we go forward. And so we sort of get down to about 4.5% by the end of 23 and something like 5% by the end of this year. So big reductions as we go. Then finally, on the RBA, I don't think it's going to do anything soon. Maybe late 23 at the earliest, but more likely 24. The RBA is talking about not until at least 24. There'll be a few twiddles in terms of some of the settings. So QE, they've basically announced 200 billion. They'll probably announce another 100 billion and then maybe taper it. And they've got this thing that they want the 3-year bond to be no more than 10 basis points. Now, the 3-year bond they're targeting at present is April 2024. There's a question, will they roll it to November 24? On our numbers, probably not, which they might make as a big, or get interpreted as a big surprise. But it's just saying, well, we're sure we're not going before 24. We're not sure if we're going in 24. And if we do, then there's no point targeting the November bond. But that's 2 to 3 months away. So my bottom line on rates is we're going to keep it as stimulatory as possible for a long time. You've got JobKeeper, but as I was saying, JobKeeper is a tail issue rather than a general issue. They do need to help things like accommodation for travel agents. And they've already tried with, we'll pay half your airline and CBDs. So, Chris, I might stop there and come back, and I think you're going to ask me some questions.
Good, thanks, Alan. Fantastic as always. And thanks everyone who's asked the question. We've got a few coming through, and please, I just encourage you, if you haven't asked the question already, just to pop one in. The first one, cheap money is fueling growth in residential prices, economic and social imbalances will be exacerbated. However, there's no doubt rates will need to and will remain lower for a lot longer. The question, where and how will prudential regulation fit into constraining property?
Well, okay, so the long and short is they're saying they're not touching rates because rates have a lot of other ramifications, and that's why they're going to keep going on QE as well, because if everybody else is doing it, and if you don't do it, the currency goes up. At this stage, I think the APRA and the RBA are okay. They're very much looking at banks, and they're saying, you guys aren't relaxing your standards, are you? If the prices that are going, well and truly above 1% per month continue, I think they'll be uncomfortable in about 2 to 3 months' time. They're going to review their forecasts in the middle of the year in the RBA. So I think you would probably get some sort of prudential control, maybe based on loan to valuation ratio, maybe the middle of the year, maybe a bit later. It's a bit complicated because just at present, it's the owner-occupiers, not the investors. And normally, so New Zealand just announced a whole pile of additional things aimed at the investors. So it's a bit hard to target the investors if they're not borrowing. So we just have to wait and see on that one. But I suspect they'll try and do something to make sure that things just don't get out of control too much. So maybe the middle of the year, September, something like that.
Okay. Thanks, Alan. Another question. This one's from Butch Yellow. The 10-year US federal bond rate has hit 1.7%, which is pricing for economic growth and inflation. Is the current inflation in certain areas and this prediction only transitory in nature?
Yeah. So what's happened is, number one, Biden spent a hell of a lot of money. Okay. And so people are saying, well, he's going to have to then flog off a hell of a lot of bonds. And if I'm the bond holder, I want a bigger price or better price. So that means that the yield goes higher. Central bank, and they're saying in that sort of environment, if the economy is going to be strong, like 6% plus in the US, they might get some inflation. Central banks saying, well, not really. And inflation, if anything, is like 1.4 in the US, and they're targeting 2. But the markets are sort of saying we don't believe it. And that's flowing over into Australia as well, when we've seen our 4-year bond rate up significantly. I'm not sure the markets are right on this one. So central banks are saying, particularly in Australia, they're saying stuff off, basically. And so they've just said, well, we're just going to keep going, guys, you're wrong. But in the meantime, it does cause a bit of grief in terms of what the central banks will say if this continues.
Yeah. Here's a good one. Given the property prices are growing considerably despite population growth being almost non-existent, can the myth that population growth is driving rising prices in Australia for decades finally be dispelled?
Well, if you had interest rates at 0.1 of 1%, I suppose it sort of offsets it, is what I'm really saying.
Yeah.
And so population has been really important. So in the past, population growth has been really important, and unemployment has been very important as well. But we've never had interest rates like this, and we've never, RBA is supposed to be, quote, Delphic. There's nothing Delphic about saying I'm not increasing rates for 3 years, guys, and don't even think about it. And I'm going to keep doing QE, and I'm going to keep doing yield curve control until such time as you pay attention to what I'm saying. And so I think it's a trade-off of these various bits and pieces, really, to be honest. And it's also interesting that, what are people going to pay for a CBD apartment now? Are they going to pay a big price for a house that's close to the CBD or not? And just one to give you a feel, we asked a special question at the end of last year in our commercial property report. When it's all finished, what proportion of the population will be back working in the CBD? Nobody, 300 professionals in that area, thought it would be higher than 80%.
Mm.
So that's, I think, an issue. But I don't know what the answer is either, to be really honest, other than the traditional answer, which is prices in the CBD drop.
Mm. Yeah. Just on population growth, maybe just a fast follow on that.
Yeah.
Do you see labour capacity issues with a lack of, I guess, new Australians coming? And also, as an extension, where does the education sector sit if this is a prolonged, sustained, lack of, I guess, people movement across borders?
Basically, they're in trouble if it's prolonged. But our assumption is that with vaccines, et cetera, probably you're going to start reopening borders next year, international borders. And that would basically say that, population growth will move back, maybe not all the way back to the 1.7 that it used to be, but maybe 1.3 and then maybe 1.7 afterwards. One thing I think is important is I think Australia's handled the vaccine or the virus really well. We've also, relative to most people, not done a lot of damage to the economy. And so if you're looking at it, from the outside looking in, Australia's a good place to live, to invest, and and go forward. And so I think the medium-term outlook is really important. It's really good. So I could see a lot of people coming, wanting to live in Australia in a couple of years' time. But just at present, the population growth. I mean, essentially, if you think of, we used to get about half our population growth from immigration, and we got half from the locals. And so if you take off 0.7, you get a really low number. And that's what we're sort of dealing with. But I should say, as long as the states don't shut down their borders, Australia's unusual, because just in the tourism industry anyway, for every one Australian or one foreigner who comes here on travel, 3 Australians go overseas.
Yeah.
So therefore, you get more money, and you think, well, what am I going to do? I'll go to a local holiday. I think people are now starting to think, well, maybe I might even go to Queensland or Western Australia, in Melbourne, etc. But the tourism impact, unless you're just specific on international, should be offset by the locals, basically.
Yeah.
Education's a different issue, and they're sort of in trouble.
Yeah. Thanks, Alan. And maybe just a quick comment on your thoughts on the commercial property market. Back to your comments around CBDs and I guess.
Yeah. Look, I'm a pessimist. I just think there has to be an adjustment mechanism. Now, sure, you'll have less people per square foot, if I can put it that way. But, NAB's currently got, 3 big office towers in Melbourne, for example. One of them's open. So it's okay. And we're thinking of opening a new one, which might probably mean we close the other 3. So, it's a difficult issue. And there's lots of apartments that are basically vacant in CBD, particularly around universities, because there's students aren't coming. So for me, that just says commercial property has still got some adjustments to do. We haven't put a formal forecast out there, but at least 20% down, I would have thought, over the next 2 years.
Yeah.
And you do have this issue that, if you're a small business in the CBD trying to cater for people who ain't coming back, that's an issue.
Thanks, Alan. Question for Joy Tan. This is where you get your disclaimer out, Alan. How about shares?
No.
Do you feel there might be a correction?
All care, no responsibility. Look, I don't know is the short answer. People are, there's two mechanisms in the equity market. Number one, if you give the money to the bank, you get 0.1 or 0.2% interest, which is nothing. So you go looking for an alternative investment, and the alternative investment is either shares or it is housing. And so that will continue. The other thing is people saying, well, if interest rates are low, the internal rate of return is pretty low, which means that even if you run that through equity market, then maybe they're undervalued. And again, growth should be really strong, but there will be tails. So I'm not sure I'd be investing in international airlines just at present. You would generally think that the share market probably has got further to run, but there will be lumps and bumps as you go along. So JobKeeper, even though it's probably unlikely to be a macro effect, it can hurt some bits. And so therefore you just need to be careful.
Thanks, Alan. David Sachs has asked the question, with all the stimulus out there, how will this affect our near and distant future economic situation?
There's always the issue about what happens when they pull JobKeeper. And what I've said is it doesn't matter. Stimulus, I think, is really important to get the economy going. Because as an economist, I always think it's more important. The reason I want growth is I want my kids to have a job. And so if we can use that stimulus, then to avoid the worst of what's been the worst recession since essentially the Great Depression, we should. To give you a feel, Can we afford it? Yeah, we can. So we started off with a government debt to GDP ratio of 18%, and we're probably going to end up at 40. The rest of the world started off at 90. And I've just said to you, Biden's already done another 13 or so. So he's well over 100. So relatively, we look pretty good. So people haven't been saying we're about to lose our AAA rating. Basically, of course, on a beauty parade, we're looking just as beautiful, if not more beautiful, than everybody else who spent at least 10% of GDP.
Yeah. Here's a great question, close to my heart. With unemployment as it is and our dependence on China, how important is it that we provide incentive to our local manufacturing sector?
Well, it's important in the sense that you need to restructure. And I think one of the lessons out of the virus was it's not always a great idea to have the absolute cheapest in your supply chain if it's from China. So I think they have to diversify. And there's some areas like, we're all worried about AstraZeneca, and then suddenly CSL can produce huge numbers of it pretty quickly. So you need to invest in supply chain durability. And so I think that is important. And you need to support some areas that are sort of still hurting. So I think it's important, but, I wouldn't try and guess which areas of manufacturing are absolutely the best. I think you probably look at mining, you can look at agri, chemicals, and also obviously medical manufacturing. So it's part of the process, it's not the only bit.
Just your thoughts on, I guess the diplomatic tensions between superpowers and Australia sort of sitting in the middle of it all. How do you see it playing out over the next 12 months?
It's difficult. If I'm looking just at China, obviously they're belting us around the head. And if they ever figure out a way to make steel without using our iron ore, we'd be in deep trouble. But, the reality is, whilst they picked on barley and wine and all that sort of stuff, from a macro point of view, the iron ore price at $160 or thereabouts more than swamps all that. So the actual surpluses that Australia's got, they're running with China, have gone up, not down. So in the next 12 months, I think these tensions are not going to go away. And that's why I think it's really important to diversify and speed up sort of the readjustment. I think the things like, let's be closer to Japan, India, Indonesia, that sort of countries are really important. And I think a lot of people, even in Europe, would want to have a free trade agreement with Australia. So I think diversification is really important.
Yeah. Maybe just a question back on unemployment. The question is, that what are your thoughts on expats returning to Australia? They seem to be very cashed up and adding to increased property prices. What do you think will be the long-term situation with this? Do we have enough jobs in Australia to keep supporting the current trend in unemployment to support these expats?
I don't think they're as big as that question implies. There's some trying to get back. You're seeing a lot of people out of Hong Kong want to come here. I've got applications all over the place now I've got a job because one of my staff got pinched. And I'm getting a lot of sort of applications from London and New York. So in terms of the question, it's important, but it's not the ultimate. I think what you need to do is you need to sort of get the actual construction of housing going. I think one of the things that I'm a bit disappointed in is that there's not more money on public housing, because that's one way that you could basically help the construction industry, do it in the CBD, and it's quick. And I think from a social point of view, there's a lot going for that. So that's one of the areas that I think they should actually try and ramp up a bit.
Okay, thanks. We hear a lot from the RBA around their desire for increasing wages. What do you think needs to be true in our economy for that to become a reality?
you need strong growth, and you need shortages in the labour supply. Now, there are some. So they're in mining, they're in agriculture because we don't have backpackers anymore. And so you see prices there. But if wages are going to be pretty low, just think about productivity is normally about 1% per annum. So if wages are growing at, if we want inflation at 2.5, wages have to grow at 3.5. So that's what they're out there trying to say. They're trying to say, look, we need the consumer to get more money. And JobKeeper is disappearing, and so we need to fill that in. And until you get wages like that, you're never going to get inflation in the 2 to 3% range. And that's why they're really saying, yes, the economy's come back and it's really good. Yes, there's some minor hiccups on the way, but I'm not increasing rates because I really want inflation to 2.5. And so to 2.5, I need 3.5. And current wages numbers are 1.4, which is an all-time record low. Now, I would expect they'll get back up to 2. I think it's going to be a long time before they get above 3, which is where the Reserve Bank's at. So that's the context that they're talking about why you need wages growth. And it is unusual to hear a central bank government saying they want everyone to give some wages.
Yeah. Probably another question here. What's your views on the government's agenda around taxation and any reforms that they may be considering, and how easy may those reforms be to actually
get them through? Look, I don't have any problems with the idea that you sort of broaden the base, lower the high income tax rates. I think they're quite high in Australia by international standards. I'm sort of less impressed by corporate tax cuts, because corporate tax cuts without big reductions in personal income tax really don't do very much to the domestic economy. What they tend to do is they widen the gap between the top marginal tax rate and the corporate rate. So people that are paying most of the tax have to pay more. The only advantage of lower corporate tax rates is it should then lead to foreigners investing more in Australia. But I'm not sure that's such a big issue just at present. So for me, I like the idea of trying to get more money into the consumer via tax cuts. Whether they'll get it through is a different issue. And I thought last year it was interesting. They'll do phase 2 of the tax cuts, but phase 3, when the opposition said, no, we're not going to do that, they just said, no, we'll do that later. So those things all help, but it's getting the consumer there. And also the other thing that's really important is getting businesses have enough confidence to actually take their money and invest it. Because if they do that, then the whole economy develops a momentum, but you probably don't need the tax cut so much. But just at present, it's not happening. It's the problem. And that's why the central bank governor is also out there saying, guys, you've got to invest. And the statistic he brings around with him is, and he's right, is that if you look at non-mining investment as a percent of GDP, it's at a 50-year low.
Probably last question, because we're nearly about out of time. And thanks everyone for your questions. This one is from Imran Juma. Insolvency is relatively low.
Yep.
Could say helped predominantly by government handouts. What's your view over the next 12 months on insolvency?
Well, if you believe the insolvency experts, they all think it's going to be really good. My sort of response is, I think there'll be a little bit more problems on home loans. We as a bank sort of took the argument that, okay, guys, you've had your holiday, now we want you to come back. And what we found is that those who didn't want to come back very quickly went to what we call SBS, which is sort of the bad bank. Other banks have tended to say, oh, have an extra holiday. So I suspect, now, context, this is tiny, but it sort of has occurred. So I think mortgage stress will probably improve a little bit, but I'm talking about 1 to 1.3, whereas in the States at present, normally bad debts to the book is about 4. So, context is still brilliant, but is a little bit worse. So I think, and there has to be insolvencies in things like CBDs and accommodation, where you still 50% down, they don't get any help. And
Yep.
I'm not sure they're going to get enough help.
Thanks, Alan. And look, we're out of time. Thank you, everyone, for your great questions. Unfortunately, we couldn't get through all of them. Hopefully, we've covered most of the topics. Alan, thanks for your presentation. I think it was really insightful. But a big thank you to all of our broker partners who took the time today to register and join this event. And we just hope you're keeping well if you are in some of those areas impacted by weather. But we wish you well for the rest of the day. And, you know, obviously, to Alan's point, the economy continues to recover. We've got a big role to play in that. And NAB is the big business banker right behind you. And we look forward to working with you and more of your customers. Have a great day, everyone. Thank you for joining us.